Hello everyone, I hope so you will be fine. So today we are going to start study unit 2. Actually, we are into the section. This section is called financial statement analysis, and it is going to be your 20% of your exam. And in this financial statement analysis section, so we have total 3 units. So we have a unit 1, which is about liquidity ratio, solvency ratios, and leverage ratios. And unit 2 is about profitability ratios and per share ratios. So then we will study unit 3 in future. So we'll talk about activity ratios and earning quality. So in unit 2, this is what we are starting today. Okay. Second unit of financial statement analysis. In unit 2, we have these 3 topics in total. So 2.1 is about profitability ratios. Topic number 2.2 is about factors affecting the reported profitability. And topic number 3, which is 2.3, is per share ratios. So starting with this topic, profitability ratios. So here we go, guys. So let me give you idea first about the profitability ratios. So in generally, we will discuss here 5 ratios of profitability. Okay, generally 5. So first ratio, we will discuss about gross profit ratio. Okay. Second ratio, we will discuss about operating profit ratio. Third, we will discuss about a net profit ratio. And then we have a return on asset and return on equity. Okay, so we'll discuss the basic version also. And then we will talk about DuPont model also for these 2 ratios, return on asset and return on equity. And we will practice the question. So let's start. Before moving to the question side, let me give you a quick idea of income statement, because we need information from income statement also. So you must know the format of income statement. So I hope so you have idea about that. So I'm just writing a condensed format of income statement. Like when we prepare the income statement, generally first we write here net sales value. Net sales, I'm not writing complete format. I'm just giving you hint. Net sales means sales minus sales return, right? So it is your net sale. From net sale, we always deduct what? Cost of goods sold, right? So cost of goods sold, I hope so you have idea about that. So then it is called what? Gross profit. Then from gross profit, we deduct usually operating expenses. And operating expenses has 2 main category. So we have a selling and marketing expenses and administration expenses. Then this is called your what? Operating income. Okay, guys. And in this operating income, we may have plus or minus for other gains or losses. Other gains or losses. Okay, so other gains or losses means it's not from operation, maybe it is from sale of assets, etc. So then this is called what? Your profit before interest and tax. Profit before interest and tax is also called earning before interest and tax. Okay, any word you can use, EBIT or PBIT. From there you deduct interest expense. So this is called what? Your profit before tax. From there we deduct tax expense. So this is called your net income. This is the format of income statement. So guys, whenever we will calculate gross profit ratio, so we need this value gross profit. Okay, and we will divide this value by net sales. And whenever you want operating profit ratio, actually we need this operating income and we will divide with the net sale. But if there are no other gains or losses are there, in that scenario, your operating income is equal to profit before interest and tax. Right or wrong? For example, if you don't have any other gains or losses, so then this operating income is equals to profit before interest and tax. So that is why sometimes these 2 terms can be used interchangeably, operating income or profit before interest and tax. So whenever whenever you will calculate operating income ratio, so we need income statement and we will divide with the net sales value. And whenever you will calculate net profit ratio, So we need net income value and we will divide with the net sale value. Okay, please, we will divide with the net sale. Actually, if you will remember this thing we have studied previously under common size financial statements, right? So where we were converting our traditional financial statements to common size, I mean say to the percentages, right? And this was known as vertical analysis there, right? Vertical. So this is what these three ratios we are going to discuss. So starting from here now. So that is why uh, it's a kind of vertical analysis, especially for the three ratios, for gross profit, for operating profit, or for net profit. So first ratio I'm going to start now. So please don't forget the heading. It is written here, vertical analysis revisited, right? Because you are going to repeat those same things. Understood? So first we are discussing here gross profit percentage, how it is calculated. So guys, the numerator, we will always take gross profit. And gross profit, how you will calculate? You need net sales minus cost of goods sold. Actually, net sales minus cost of goods sold equals what? Gross profit. So we need numerator as a gross profit. If gross profit is straight away given in the question, we will use that one. If it is not given, so then you should know the formula how to calculate gross profit. So this is how it will be calculated. We need net sales minus cost of goods sold equals gross profit. And that gross profit you will divide with the net sales value and you will multiply with the 100. So you will get the answer into percentage. So this is what is called gross profit percentage. Okay. So please remember a gross profit margin percentage or gross profit margin. So gross profit margin is also called gross margin, or it is also called simply gross profit. Anybody can use. You can use the word gross profit margin or gross margin or gross profit. It is the same thing, right? So, and what is the gross profit? So actually it is the value of sale, but after the deduction of cost of goods. So like whatever the profit is left or whatever the sale value is left after the deduction of cost of goods sold. So that is called your gross profit. So simply how it is calculated? It is calculated by subtracting cost of goods sold from net sales. Right or wrong? And what is the analysis actually? What we are trying to analyze here. So the key analysis with respect to the gross profit margin, like what is the analysis of this ratio, is whether it remains stable with the increase or decrease in sales. So guys, please remember here, ideal situation is what? So ideal situation is that, for example, if your net sales, let's assume if this net sale increased by 10%. So this is the ideal situation. So mostly this should happen like that. So your gross profit should also increased by 10%, right? Approximately. So if your, let's assume net sale is decreased by 10%, so then your gross profit should also be decreased by 10%. So mostly gross profit, mostly it should be constant with the sales. Okay, or it should be related with the sales. If sales will increase with X percentage, ideally gross profit should also increase with that X percentage. Or if sale has decreased with X percentage, so gross profit should also should have decreased by that X percentage. Understood? So this is what is the point you should remember. This is the analysis. But if you are facing this scenario, let's say your sale has increased by 10%, but gross profit has increased by only 2%. It means there's a problem. Problem maybe it could be with the cost of goods sold, right? Maybe your cost of goods sold is higher. Due to that, your gross profit is lower, right? So ideal situation, I have already told you, ideal situation is that if sales moves with any X percentage, so gross profit should also move in the same direction with almost same percentage. This is what is the analysis, and that is why we are trying to do it. So this is what, guys, this is what I was saying. So our purpose is to see whether it remains stable. What it gross profit remains stable with increase or decrease in sales value. Understood, guys? And please remember, gross profit ratio is also important because this gross profit value will affect your other values also. Which other values? For example, if your gross profit will reduce, obviously it will affect your operating profit, that will also reduce. It will affect your PBIT, that will also reduce. It may affect your PBD, that will also reduce, and net income, right? So that is why this is really important to understand. So gross profit. Okay, so gross profit is really important because if this will increase, so there are more chances that your operating income will increase, your PBIT will increase, your PBT will increase, and your net income will increase. So that is why this ratio is really, really important. So I'll show you question how questions will be tested. Okay, so ratio I just explained. So the ratio was how to calculate gross profit margin percentage, right? So we need a gross profit as a numerator divided by net sales and multiply by 100. So for example, I'm just assuming the values here and let me explain what is the interpretation also. For example, gross profit is $20 and sale value is $100 and multiply by 100. So you got the answer 20%. So what it means? What does mean by 20%? So whenever you interpret the ratio, so you have to link a numerator with the denominator. Okay, or the denominator with the numerator. For example, if I will link the numerator with the denominator first, so it means my gross profit is 20% of my sale value. Let's assume if I'm making a sale of every $1, so it means that leaves 20% of profit. So 20% of $1 will be what? $0.2, right or wrong? So first interpretation is that our gross profit is 20% of sale value. Second interpretation is that my sale is leaving 20% profit after the deduction of cost of goods. So which profit? Gross profit. And please also remember, higher ratio is always desirable. So obviously it's a profitability. We don't want our profitability to be lower than our past, than our competitors, or than our industry average. So we want higher, right? So then guys, we have a second ratio, which is called what? Operating profit margin. Again, as I told you, it's a kind of vertical financial statement analysis, right? So operating profit margin. So as I told you, usually please remember here, operating profit is this value. If I show you income statement format, usually this is our operating income. So this is our operating income, right? But if you don't have any other gains or losses, then operating income is also known as profit before interest and tax. So now, so mostly this will not be given in your exam question, other gains or losses. So we will assume our operating income is also profit before interest and tax. So how this ratio is calculated? Simply what you will do, you need operating income. Okay. So the operating income divided by what? Net sales and multiply by 100. And operating income can be given, as I told you, with the name of what? Profit before interest and tax or earning before interest and tax. So these are the alternative name for operating income. So actually, whenever you take operating profit margin, okay, like when you calculate operating profit margin percentage, so what we do, so they are saying that the operating profit margin is the percentage that remains obviously after selling and general and administrative expenses have been paid. So yes, because when we calculate operating income, so how we calculate operating income? So we actually took here first sales, then cost of sale equals gross profit. From gross profit, I told you we will deduct these expenses, operating expenses. Which operating expenses? Selling and marketing and administration expense. So then it is your operating income, right? So this is what they're saying. The operating income is the profit which is left after the deduction of operating expenses. Okay, operating expenses means selling and marketing or administration expenses. Okay, so this is what is the written there. So then we will calculate into percentage, right? So for example, if let's assume, I'm just assuming, I'm saying that my PBIT is $10, my net sale is $100, multiplied by 100, so answer is 10%. So again, how you will interpret it, it means operating income is 10% of your sale value, or your sale is generating 10% of operating income. And again, higher answer is desirable, right or wrong? So then we have here, guys, a third ratio, which is called net profit margin ratio. Okay, so ratios are easy ones. I'll move to the question. So question can give you some challenges, right? So net profit margin. So net profit margin is the percentage. You know, the net profit margin was the last value of the income statement, right? In my format. So net profit margin is the percentage that remains after other gains and losses, including interest, expenses, and income taxes have been added or deducted. So this is what they are saying. I have already told you. So net income is what? Obviously, if you are sitting at the operating income point, so then you have to add or deduct other gains or losses. So this is called your PBIT. Then you have to deduct interest expense. This is called your PBT. Then you will deduct tax expense. Then this is the net income. So this is what they are saying. They are saying that so net income is the operating income, but after the deduction of other gains, after adding or deducting the other gains or losses, interest expenses and tax expenses. So this is what is called your net income. Like once you will deduct these, you will add or deduct these things, interest, tax from the operating income, obviously you will get what? Net income. This is what they're trying to tell you here. It's similar, just a simple definition of a net profit. Okay, so again, we'll go through net profit. So net profit margin is the percentage that remains after other gains and losses, interest, expense, and income tax have been added or deducted, right? And how this ratio is calculated, we always calculate this ratio, like which ratio? Net profit margin percentage. So we'll take net income divided by net sales and multiply by 100. So this will give you answer into percentage. Again, I'm just assuming, for example, let's assume my net income is $5, my net sale is $100, multiply by 100. So answer would be 5%. So what does mean by this 5%? It means net income is 5% of sale value, or my sale is generating 5% of net income. Okay, so net income is the income which you got after the reduction of all expenses, right? Operational expenses like selling, marketing, and admin, finance related expenses like interest and tax expenses, right? So again, higher answer is desirable. Okay, answer should be higher than your past. If you are measuring your performance, it should be higher than your competitor. It should be higher than your industry average, right? And now we have here simply, with the help of small example, just I want to tell you how these ratios are calculated. And then I'll show you some exam standard questions also, obviously. So for example, this is again the format of income statement. So we have here the first value of net sales of 1.8 million. Then we deduct cost of goods sold, which is 1.45 million. So this is equals your gross profit. Okay. So if I want to calculate gross profit percentage, how you will convert? I'll take gross profit value, which is 350,000, and I'll divide with the net sale value, which is 1.8 million, and multiply by 100. So obviously this will give you answer in percentage, and this percentage is going to be 19.4%. So then obviously from gross profit you will deduct selling and administration expenses. Let's say that is 160,000. So this is called your operating income. So operating income is how much? 190,000. Okay. So if I want to convert operating profit margin percentage, so I'll take 190,000, which is my operating income, divided by with the net sale. Net sale is how much? 1.8 million, and multiply by 100. So this will give you how much answer? It will give you 10.6%. So then obviously we will plus or minus other income and losses. Here, let's assume this value is deducted. It means we will assume this is a loss. So this is called EBIT. Okay. If please remember, when you calculate operating profit percentage, so and operating income is given separate amount and EBIT is given as a separate amount, then you have to use operating. If there are no other income and losses, then EBIT obviously will be equal to your operating income. So, but here it is different, right? EBIT is different than your operating income. So then we'll deduct interest expense. This is called earning before tax. Then we'll deduct tax expense, whatever it is. So this is called your net income. And if I want to convert, I want to calculate net income margin percentage. How I will calculate? I take this value net profit, which is 81,000. So divided by net sale, which is 1.8 million, and multiply by 100. So this is going to give you 4.5%, right? So this is how these ratios will be calculated. Now, let me tell you here, guys, there is a one more ratio is there, okay, which is called what? Like sometime in some ratio, this ratio we also calculate. Which ratio? We calculate this ratio, EBITDA margin percentage. So what is EBITDA? So EBIT mean to say what? This you already know till here. It means earning before interest and tax. Then what is DA? DA stands for depreciation and amortization. Like simply if you have a EBIT, okay, EBIT, which is earning before interest and tax. So you will simply add back depreciation and you will add back amortization expense. Okay, depreciation is always on tangible assets and amortization is always on intangible assets. So this is called what? EBITDA. Okay, so actually why some companies use EBITDA? This is the question. Actually, so they take this EBITDA as a proxy for cash flows. Because in cash flows, we don't include depreciation and amortization, right or wrong? Because it's a non-cash based item. So whenever you prepare even cash flow statement, so you remove these item as a adjustment, right? In under cash flow from operating section, right? Operating activities, right? So this once we will take EBIT and we will add back depreciation and amortization. It means so we will get EBITDA, and this EBITDA we are using as a proxy for cash flows, not more than this. Actually, maybe this EBITDA value is not equal to exact to the cash flows, but as I'm saying, it can be used as a proxy for cash flows. Understood? Because the depreciation and amortization do not require any cash outflows, right? So that is why we will exclude this depreciation and amortization. How we are excluding? By adding back. Because this depreciation and amortization, it has already been deducted, in the income statement. So if you will add back, it means you are removing these values from the profit, right? So just we are trying to approximate current cash flows. Understood? So that is the just point here. As I told you, mostly banking sector, they use this ratio. So we'll take EBITDA as a numerator, and EBITDA, I told you how you will find it. So you will take EBIT from the income statement and just add back these two non-cash based items. You will get EBITDA. So EBITDA divided by net sale. What is EBITDA? Earning before interest and tax, depreciation and amortization. Understood? So, and we will divide with the net sale multiplied by 100. So this will also give you answer in percentage. So guys, simply let's assume if answer is 10%, it means your EBITDA is the 10% of sale value, or your sale value is leaving 10% of EBITDA. And again, higher answer is desirable. So what now in your exam question, they may ask you to write about, or to maybe select the option from MCQs about advantages and disadvantages. So what is the advantage of this ratio? The advantage is this. So EBITDA we are using as a proxy of cash flow. So it is very close value to the cash flows by the. I'm not saying it will be exactly equal to the cash flows which you will get under operating activities, but it will be close to that. Okay. So but the point is that, so what are the drawbacks? So there are two main drawbacks are there. Disadvantages of EBITDA if you are using in your ratio this value EBITDA. So first advantage is, disadvantage is that it overstates income. Yes, because for example, if you will add back depreciation and amortization, actually these are your expenses, right? So it must be covered from your sale value. But if you are adding back based on that these are non-cash based item, right or wrong, it means you are trying to overstate your income. And if you will try to overstate your income, obviously it will distort reality, right or wrong? It will distort reality, because from stockholder standpoint, or from stockholder point of view, so investors are most concerned with the level of income and cash flows available after all expenses. So right, so but we don't include these two expenses while we calculate this ratio. So that is why it will overstate your income. This is the first drawback. So what is the second drawback? So as I said before, that this EBITDA is the proxy for cash flows. Is the proxy for cash flows. But if you will think in reality about the statement of cash flows, so there we don't just reverse the depreciation and amortization. We also include other things under operating activities. Other thing is what? We also include the changes in working capital. Changes in working capital is what? Like changes in current assets and current liabilities. Right or wrong? Because changes in current assets and current liabilities, mostly it is not affecting your income statement. For example, if you have made payment to the supplier, so what entry you will pass? You will debit the supplier and you will credit the cash. So see, nothing will go to the income statement, but it is having a cash flows effect. So right around, so this is what I'm trying to tell you. Or for example, if you will I'm just giving you examples as I give you example. For example, if you have received the cash from customer, what entry you will pass? Debit cash and credit receivables. So please remember, both cash and receivables are balance sheet item. Nothing will go to income statement, right or wrong? But it has cash effects. So that is why this adjustment in current asset like receivables and current liabilities like payables. So these adjustments are not included in EBITDA. So that is where the drawback is. So the EBITDA value neglects the working capital requirement. Understood? As I told you, the changes in current assets and current liabilities are not being recorded in EBITDA, but these things are recorded in the cash flow statement, right? So that's why we cannot say it is the 100% proxy of cash flows. No, it's not 100%, but it is close to that. Okay, so this is what is advantage and disadvantage. Now these are very simple and basic ratios. I have already explained three ratios. So now before moving to the next slide, let me show you how questions can be tested from here. It's very simple question will come from this topic, and but once I'll add ROE, I mean return on equity and return on assets, so question will become difficult. So here we go. The question is they're saying in year 3, gross profit margin remain unchanged from year 2. Let's see if you have 2-year data, year 2 and 3. So here gross profit, let's see if it is $100, it is same like $100. He told you, so gross profit margin remained unchanged from year 2 to year 3. So it's not changing. It's not changing. Okay. But in year 3, what happened? The company's net profit, last value of income statement. But in year 3, the company's net profit margin declined from the level reached in year 2. So what they're trying to tell you here, they're saying that, so okay, GP is constant in 2 years, but net profit has decreased in year 3. Okay, so why it has decreased? Now you have to think about that. Why this could have happened? Like why net profit has decreased? So this could have happened because in year 3, option number 1, our corporate tax rates increased. Yes, actually this is very correct statement. The reason is that when you prepare the income statement, so we write net sales, shortcut again, minus cost of goods sold equals gross profit minus operating expenses equals operating income. So more shortcut I'm writing now. Okay, so minus interest expense equals PBT minus tax expense equals net income. So what he said, this value is constant. It has not changed in both years. But this value has reduced in year 3. Why? So obviously there's only 2-3 reasons are there. Maybe your operating expenses has increased. He didn't say anything about operating expenses so far in the first option. Or maybe interest has increased, or maybe tax has increased. If these 3 items will increase, operating expenses, interest or tax, so your net income will decrease, right or wrong? Because gross profit is constant. So now here what he said, he told you in third year, in year 3, a corporate tax rate has increased. Yes, it is your expense. If your expense will increase, obviously your net income will decrease. So this is the correct option actually. This is the answer of the question. But we have to look why other are not correct option. Here we go. So they're saying in option B, cost of goods sold increased relative to sale. Guys, cost of goods sold will affect your gross profit, right? So for example, sales minus cost of goods sold equals your gross profit. And if your cost of goods sold will increase, your GP should decrease, right? GP should decrease. And then net income should decrease. But he told you GP is the constant here in the first line. So it means this is not true answer for this question. Then we have a third option. They're saying sales increase. Okay, if sale will increase, then GP will increase. Then GP will increase. So, but he told you GP is constant. So they're saying sale increased at a faster rate than operating expenses. No. Okay, if sale will increase, obviously first GP will increase. But he told you GP is constant. So this is also not the option. Then we have a next question. They're saying, next option. Common shares dividend increased. Please remember, guys, dividend payments like to the shareholders, we never record an income statement. Please note this point. So you have never seen, right? Dividend expense. Have you seen ever dividend expense in the income statement? No, we don't record any dividend expense. So common share dividend increase means say we are paying more dividend to the shareholders. So please, if even you are paying more or less, it won't affect your income statement. So that is why this could not be the reason, because dividend payments are never payments I'm talking about, not dividend receipt. So dividend receipt can be recorded as income in income statement, right? But dividend payments which you are paying to your shareholders, so that is never recorded as expense in the income statement. So that's why it won't affect your net income or gross profit, because this item is never recorded in the income statement. So the first option is the correct answer. Then we have, guys, here another question. For example, they're saying a company has, what is the question? They're saying, what is the company's operating profit margin? You have to calculate operating profit margin percentage. Okay. So now here we have a small question again. A company has a sales of 100,000, cost of sales of 40,000, interest expense of 4,000, tax of 18,000, and operating expenses of 15,000. So what the question is, what is operating profit? So first, you should know how to calculate the operating profit. You have to write net sales, which is 100,000 given in the first line. From there, you will deduct cost of goods sold, which is given 40,000 in the first line, equals gross profit, which is 60,000. From there, you will deduct operating expenses, which could be given with the name of selling and marketing and administration expenses. But here he told you operating expenses directly, 15,000. So this is called 45,000 is called your operating income. You don't need to subtract interest. Where is interest? This. And tax. You don't need to even subtract tax, because we need operating income only. And operating income we got, because we have to calculate operating margin. So now we can calculate the ratio. So operating margin is calculated how? So we need a value of operating income divided by net sale value. Okay, operating income is how much? 45,000. And net sale value is 100,000. And multiply by 100. So this will give you 45% as answer. Okay, guys. Now let's move to the next ratios. It's important now, and questions will become a bit more technical. Okay. So guys, we are discussing here first. These are also profitability ratios. Okay. So, but these ratios will use some data from income statement and some data from balance sheet. Because in previous three ratios, like we discussed gross profit, operating profit, net profit ratio. So that the data for all these three ratios we can collect from the income statement only. But when you calculate return on asset or return on equity, so we need value from income statement also, and we need values from balance sheet also. So both values are required now. So return on asset, first of all, how it is calculated. But please remember, don't forget the formula. Okay. So first let me tell you here a formula, and then I'll explain. So return on asset, this is the formula. So you can take net income divided by average total assets and multiply by 100. So you can get answer into percentage. So net income obviously you will get from the income statement, and average total asset. Average total asset, how you will get, guys? So here you need, please remember, average total asset whenever you are working. So you need opening total assets. I hope so you have idea about assets, right? Total asset means say current asset plus non-current assets. So you need opening assets. Opening asset means say closing assets of the last year, plus you need a closing asset of the current year. So opening asset plus closing assets divided by 2. So this is how you get the average. Please make sure if opening assets are not given, so then you don't need to get average. So just simply divide your closing assets. So it means, what is the formula? So net income divided by average total assets or closing assets. If opening assets and closings are given, then take average. If only closing is given, just use the closing, then don't calculate average. Okay. Net income divided by average total assets or closing assets multiply by 100. So this will give you answer in percentage. And let's assume I'm just uh, telling you the values. For example, net income is 81,000. And average asset is what? Let's assume opening asset. I'm just putting the fake values. Let's assume opening assets are 1.8 million plus closing assets are 1.6 million and divided by 2. So average asset will be how much? Average asset will be 1.7 million. So 81,000 divided by 1.7 million multiplied by 100. Okay. So let's assume our answer is 4.76%. So what it means 4.76%. So now you can interpret in two different ways. Number one, first way is what? First way is what? Your net income is net, because I'm trying to relate numerator with the denominator. Your net income is 4.76% of asset value. Or in other word, whatever the investment you have made in the asset, like in my example, you have made investment, average investment is 1.7 million. So whatever investment you have made in the asset, so that is generating 4.76% of net income for you. So third, I can also interpret this way. For example, each dollar invested in asset is leaving a net income for you how much? 4.76% of $1. Like each dollar invested in asset is leaving 4.76% of $1. 4.76% of $1 will be what? Maybe point zero, sorry, maybe point, whatever you can just convert 4.76% of $1. So it will give you maybe 0.0021. Okay. So it means each dollar invested in asset is leaving this much profit for you. Understood? So you can interpret this way also. So anyhow, so our ultimate objective is what? So whenever you calculate return on assets, so our main purpose is to check how efficiently we are deploying the resources of business. Okay, resources means asset. So this is actually what I'm trying to say. How well a management is deploying the firm's assets in the pursuit of profit, or how well a management is deploying or using the firm's assets to make a profit or to earn a profit, right? So this is what is return on investment, right? So because assets are your investment and net income is your profit. So how much profit you are earning on your asset, right? Because assets always contribute to the earning of profit, because through assets you will manufacture the goods, right? Right or wrong? Maybe you will pack the goods through assets only, right or wrong? So maybe you are using warehouse, etc. So many assets, different assets you may have, right? So we always deploy the assets to make money, right? So this is what we are trying to see, how well a management is deploying the firm's assets to make a profit, right? And again, higher answer is desirable. Clear, guys? So you can interpret it in different way. So now here we have another uh, another ratio which is called return on equity. Then I'll show you some other two, three more small formulas. So return on equity. Again, return on equity, what? First, let me explain the formula. Return on equity mean to say, please remember here when we take equity here, guys. So ideally, we are talking about common equity only, okay? Common means say ordinary shares only, not preferred shares. So usually preferred shares we exclude from the equity. Okay. For example, in equity section, first of all, remember, I hope you have idea. We always write common stocks. Common stocks are also called ordinary shares, right? So we have their par values. It's written in the balance sheet. We have additional paid in capital. So we'll add these. Plus we have retained earnings. Plus you may have treasury stock. That treasury stock you have to deduct. Treasury stock means the stock which you have repurchased. Okay. So usually these are main 4 or 5 items are there. You may have OCA item also, plus accumulated other comprehensive income. So this is what is called your equity. Please, if in the exam question, this is what is my opinion. If he told you a preferred stock in between here, please exclude the preferred stock until unless he used the formula for equity, which is including the preferred stock. Because there are different formulas are there. Sometimes we in some industry in equity they include the preferred stock also. But if they want to include the preferred stock, so he will give you hint in the question. Otherwise, you should remove the preferred stock from the equity. Just take common stock plus common stock two values, par value, additional paid in capital, retained earnings, treasury stock, you will deduct other accumulated comprehensive income. So this will give you value of equity. Okay, this will give you value of equity. So, and remove the preferred stock. I'll explain because there are problems with the ratios because different formulas are available. So whatever formula you are going to apply, so that formula should be applied consistently on year by year basis. Okay, don't change it then. So, but in your exam question, if preferred stocks are given, so I would recommend you just to exclude the preferred stock from the calculation. But if he told you that preferred stock are the part of equity, then include it. Otherwise, exclude it. Okay. So return on equity, how it is calculated, we'll take net income. divided by average total equity. Okay, again, average equity, how you will calculate? We need total equity of last year, which is called opening equity value plus closing equity value and divided by 2. So if opening and closing is given, so then we need average. If opening is not given, then you can use here instead of average, you can use just closing equity and then multiply by 100. So this will give you return on equity. Okay, guys. So for example, I'm assuming, let's assume my return on equity is, let's assume 5%. If I after multiplying it is, let's assume 5%. So what does mean by this 5%? 5% mean to say my net income is 5% of equity value, or the whatever the investment we have made through the equity, so that is generating 5% profit, okay, based on equity investment, right? So, or we can say this way also. So each dollar, if I'm taking $1, if I have invested $1 of equity into the business, so that leaves 5% profit of that. Okay, that leaves 5% profit of that. So it will give you whatever answer 0.05. It means each dollar which we have invested through the equity is generating $0.05 of profit. Okay, guys, please recheck the calculation because sometimes I'm using calculator manually, so it might be wrong. So please recheck. Okay. Now, guys, let me tell you here. Now I'm just moving to some other things. Please make sure one thing. So what was the formula for return on asset? What was the formula? Now it's these things you have to think actually. So formula was net income divided by average total assets or closing assets. Because if opening and closing is given, then you need to use average, otherwise closing asset multiply by 100. And then what is the formula for return on equity? So return on equity formula is net income divided by average equity, total equity, or closing equity and multiply by 100. Average is needed if opening and closing equity is given. Okay. Otherwise, if closing is given, just use closing and multiply by 100. Now, guys, please remember, can you tell me here denominator is total asset, for example, and here denominator is total equity. So it means just this is what point I'm trying to highlight. So total asset, just think about assets. Assets are always equals, right? In accounting equation, assets are always equals to liability plus equity, right? In this ratio, I'm using asset value. It means asset includes both things, liabilities plus equity, right? Am I right or wrong? Because usually we say asset is what? Current asset plus non-current asset. That is true. That is asset. But asset should be equal to liabilities plus equity. It means asset includes liabilities values and equity values. But if you will think about this denominator, it's only equity. It means what's that? It's only equity. It means what's the difference between denominator here? So difference is that liabilities. So liabilities are the part of return on asset formula because liabilities plus equity will be equal to assets. It means liabilities are here in this value, right? But in this value only we have a equity. So that is why what I'm saying, this is what is the point I'm trying to tell you. So the difference in the two denominators which we have used in return on asset and return on equity is the total liability is the difference. So that is why this is the rule of thumb. Return on equity will always be higher, will always be greater than return on asset. What is the rule? If there are liabilities, then return on equity will always be higher than return on asset. Okay. If there are liabilities. If there are no liabilities, for example, liabilities of the business is zero, then return on equity and return on asset can be equal. But if there are liabilities in the balance sheet, so return of equity will always be greater than return on asset. And the reason is that because in return on asset, denominator is bigger. Here denominator is bigger and here denominator is smaller. If denominator is smaller, here answer will be higher, here answer will be lower. This is what I'm trying to tell you, okay? And one more, a formula is there, guys. Please remember here. This is the alternative formula. Please, alternative formula. Okay. For what? Return on asset. How to calculate return on asset by alternative. So first formula I told you what for return on asset, if you remember. For return on asset, previous formula, what was the formula I told you? Return on asset equals what? Net income divided by average total assets, right? And multiply by 100. But this is alternative formula. If you will use this formula, this will give you almost same answer. But how this formula or what is this formula? Return on asset. Return on asset is always equal to return on equity. You need return on equity multiplied by 1 minus debt ratio. This debt ratio he will tell you in that exam question. Okay. Mostly debt ratio is what? So we take debt divided by equity. This is called debt ratio. Okay. Or sometimes debt ratio could be given debt divided by total asset also. But most probably this equation we used. Okay. So debt ratio. So 1 minus debt ratio. So debt ratio answer he will give you in the question. It means if I take 1 minus debt ratio, so it means this will give you value of kind of equity. And if I'll multiply with the return on equity, so I'll get the return on asset. Okay. I'll because here we are removing debt ratio, right? So 1 minus debt ratio. So whatever answer you will get, so this you will multiply with the return on equities, you will get return on asset. So let me write it here and let me tell you other way around also, because he can ask you same equation I'm writing here. Okay, for example, this is the question in front of you. ROA, return on asset equals what? Return on equity times 1 minus debt ratio. Okay. Now, can you tell me if from this equation, let's assume if ROA is given and debt ratio is also given, can you calculate return on equity? Yes, we can calculate. So return on equity will be equal to what? Return on asset divided by 1 minus debt ratio. Right or wrong? If you will solve this way, so you will get return on equity. So please, you have to read the question very carefully. If in exam question, he told you debt ratio, okay. He didn't tell you average total assets, net income, but he told you, for example, return on equity and debt ratio. It means we can calculate return on asset. Or if he told you return on asset and debt equity ratio, it means we can calculate return on equity. Right or wrong? So this is the alternative way. So I'll show you with the help of question also, please. So here we go. Then guys, we have another just a formula. So like this is what sometime he will ask you to calculate growth rate. And this growth rate is called sustainable growth rate. So what is the formula? This is just to calculate growth rate. It's just a new equation. Okay, it has no linkage with the previous. Ignore the previous now. Okay, it's just a new equation. Sometimes he may give you data in the exam question, and he may ask you to calculate the growth rate. And growth rate, how you will calculate? I'll explain the logic of this also. So we'll take return on equity into 1 minus dividend payout ratio. Actually, what is dividend payout ratio, right? First, let's understand. So dividend payout ratio is always calculated this way. This ratio we'll discuss in future also, but it's just a formula I'm telling you. Like dividend payout ratio. Dividend payout ratio is calculated this way. We take dividends to common shareholders. We are not taking preferred dividend here. Only dividend which you are paying to common shareholders, ordinary shareholder, not to the preferred. Divided by income available to common shareholders. But the point is that what is income available to common shareholders? Income available to common shareholder is always equal to net income minus preferred dividend. So net income minus preferred dividend is called income available to common shareholders. If you are taking a dividend to common shareholders divided by profit which is for common shareholders, okay, so multiply by 100. So this will give you dividend payout ratio. For example, dividend payout ratio is 40%. Let's assume answer is 40%. So what does mean by this 40%? It means whatever profit we are earning, whatever. So we are paying 40% of that profit as dividend. Which dividend? Common dividend. Understood? So for example, if answer is 60%, so whatever profit you are earning, it means we are paying 60% of the profit as dividend. This is called dividend payout ratio. So guys, now let's come back here now. So how you calculate growth rate? First, let me tell you here. So when you solve this 1 minus dividend payout ratio. For example, dividend payout ratio is 40%. So we'll write like that 1 minus 0.4. Remove the percentage. Okay. You can't do this way. 1 minus 40. So if you want to write 40% as a complete 40, then you should write it here 100. 100 minus 40. But if you are writing here 1, so then 40% should be written like 0.4. Remove the percentage. Okay. So 1 minus 0.4 multiply by return on equity. Okay. For example, return on equity is 12%. Now let me explain the formula. See, this 1 minus dividend payout ratio, if you will solve this, actually it gives you retention percentage. Like how much you are retaining. Like whatever profit, for example, you are earning. Okay, let's assume your profit is $1. Dividend payout ratio is 40%, like means say 0.4. So it means 1 minus 0.4 will be 0.6. It means 60% or 60 or 0.6 is your retention value, right? So this is actually retained earnings. 1 minus dividend payout ratio gives you value for retained earning. If that retained earning, if that retention percentage, I will invest into the business. And if I will, what I'm saying, if I will, this retained profit, this is the retained profit. 1 minus dividend payout ratio is the retained profit. Is this retained profit I will invest, and at least I will earn return equal to return on equity. So this is this, with this value, my business will grow. So in short, what I'm saying, so whatever profit you are retaining, if you will reinvest, at least you earn on that equal to return on equity on the retained investment, right? So if the retained value, if you will reinvest and if you will earn equal to return on equity, so with this value, your business will grow. This is called what? Growth rate. Okay. So as I told you, 1 minus dividend percentage is your retention ratio, actually. Retention ratio. Okay. If that retained value, I'll reinvest and minimum, at least I will earn equal to return on equity. So with this value, my business will grow. Okay. Understood. I hope so it is clear. So actually this growth rate by years, the potential growth of a firm without borrowing additional funds. Okay. Because we want to grow with our retained investment. So I hope so it is clear, guys. Now let me show you some questions here. For example, so we are going to do some couple of questions. So first of all, guys, so let's assume they're saying a firm is experiencing a growth rate of 9%. This is growth rate is given, which we were calculating now, right? So growth rate was what? Return on equity multiplied by 1 minus dividend payout ratio. So this was growth rate. So he told you growth rate. With the return on asset, ROE is also given 12%. If the debt ratio is 36%, this is the debt ratio. So, and market price of the stock is 38 per dollar. So what is the return on equity? Guys, now debt ratio is given. So return on equity, there are two formulas. First shortcut I told you, if debt ratio is given, so you can use this. Return on equity equals. Do you remember the formula? A formula I told you, return on asset was equal to return on equity multiplied by 1 minus debt ratio. But I want to calculate this return on equity. How it will be calculated now? Return on equity equals return on asset divided by 1 minus debt ratio. Right? So I will get return on equity and multiply by 100. So return on equity, let's put the value now. So return on asset is given in the question. How much? 12%. Okay. Uh, this is return on asset divided by 1 minus debt ratio. Debt ratio is 36. So if I remove the percentage, it will become 0.36. So further we can solve. It will be equal to 12% divided by 1 minus 0.36. It will be 0.64. And if I will solve it, okay, 12% divided by 0.64 and multiply by 100. So how much you will get? 12 divided by 0.64. So no need to multiply 100 because this value is already percentage. No need to multiply here percent 100, guys, because this ROE I have used 12%. If I use 0.12, then I can multiply with the 100. Okay. So because if this value I have already used as 12%, so no need to multiply with 100. So 12 divided by 0.64. So this will give you what? 18.75%. It's all math, guys. If I'm writing this not at 12%, so if I'm writing here 0.12, 12% is a 0.12 without by removing the percentage. So then I need to multiply, right? So 0.12 divided by 0.64. So then I have to multiply here with the 100 to get the answer into percentage. But if numerator I have used with percentage, then please don't multiply with 100. So you will get directly percentage. This is just a math. And you should know it. I hope so. So it means answer is how much? 8.75%. So this is the easiest way. Other way I can also apply the formula because this is the return on equity we have calculated. There was another formula for return on equity. Can you tell me the formula? Other formula for return, this is the alternative way. We can also work with this. Return on equity equals what? Net income divided by average equity. Average equity value. Okay, this formula can also be applied, but it will go long way. If you want, I can show you, no problem. So here we have solution for alternative way. This we already told you shortcut way. This is the shortcut way I already told you. So this is the full version now. So other way is what? So we can apply ROE formula. ROE formula is what? return on equity equals what? Net income divided by average equity. This is the formula. But the point is that, do we have net income in the question? No, we don't have. So first thing we need to find net income. So net income, how you can calculate? So here we go. Because from the question, I'm taking data, okay? Please remember now. So first of all, so we will assume, because debt ratio he told you in the question 36, right? Debt ratio he told you. This alternative way, guys, it will go long way, but I can prove the calculation by both way. So, but as I told you, if debt ratio is given, this is the easiest shortcut way. But if you want to apply alternative way also, so we can work with that. So debt ratio is 36%. It means I can assume if my assets are 100% or $100. So assets are always equals to what? Debt plus equity. If I'll assume my assets are 100 and my debt is 36, which is given as a debt ratio. Okay, it means my equity will be 64, right? My equity will be 64 automatically, because assets should be equal to debt plus equity. If I'll assume my assets are 100, because asset value is not given, I can assume it's 100. Debt ratio is $36. So equity will be $64. So then by applying return on asset first, return on asset, because I have now asset value also now. So return on asset formula first I'll apply to find out the net income. Return on asset equals what? Net income divided by average total assets. Okay. So return on asset is given in the question 12% here. It's given. Return on asset is given here 12%, right? So if I'll keep this return on asset here as 12%, equals net income, which I'm trying to find, and average asset I have assumed $100 here. Okay. So now net income will be equal to what? Net income will be equal to average asset multiply, because this division 100 will multiply here now, right? So we'll multiply with the return on asset, we will multiply with the 100. Okay. So I'll get automatically net income. I hope so you know the math, right? So we got a net income now. So net income, 12% of $100, net income is $12. Now I can apply the return on equity formula, normal formula. What was the formula return on equity? So return on equity is net income divided by average equity. So net income, I got it $12, and equity value I also got 64 here, because I assumed your assets are 100, debt is 36, and equity should be 64. So it means net income is 12 and equity is 64, multiply by 100. This will give you again return on equity of 18.75%. Okay, guys, then we have here another question also. So here we go. I'm just reading first the requirement of the question. What is the question? They're saying you have to calculate return on shareholders' equity. Return on equity. And what is the formula? Return on equity is net income divided by average total equity. Or there is another formula I told you, return on equity equals, alternative way, return on asset 1 minus debt ratio. So now I have to read the question. Either this debt ratio is given or this data is given. So which formula data is given? So according to that, we will apply. So by the way, this data is given in the question. Okay. So here we go. Let's read the question now. So then saying for the year just ended, B corporation had income from operation. This is operating income. I need net income, not operating income, of 198,000, and net income is 96. Yes. First value we found. Net income is given 96,000 numerator. Then what? The liabilities and shareholder equity section of B's statement of financial position is shown below. So here we have a 2 years data. This is January 1, like the data at the start of the year. This is 31st December. It means these are opening values, these are closing values, right? Okay. If now what I need denominator, I need equity now. Equity. So account payable is liability, not equity. Accrued liability is liability, not equity. Bonds payable is liability, not equity. But common shares, yes, common stock is your equity. Reserves for bond retirement. Reserves is like you kept some profit to retire the bond, to repay the bonds. It's also part of equity. Okay. Retained earning is also part of equity. It means these three items are equity. This is opening equity. This is the closing equity. I'll add these values. Opening plus closing divided by 2. So this will give you average. So if you will solve it, I'm not sure. So we can just add all these values. Like these are opening. These three values are opening. Okay. And these three are closing and divided by 2. So we have to add opening plus closing divided by 2. So if I'll add, so actually this is going to be average equity is going to be 500 and 500. You can just cross check on the question. Okay. If I do opening plus closing divided by 2. So this is 500, 500. Okay. So I'll divide with the 500 and 500 and multiply by 100. So let's see how much is the answer. 96,000 divided by 500, 500. So multiply by 100. So answer is 19.18%. So we can write around 19.2%. So it means this is the first option. Okay, guys. So then we have here other also ratio. Another question we have here. So please try to read this question. This question is also maybe technical question. Again, what you have to find it here. So they're saying you have to calculate a return on equity. You have to find again return on equity. So we'll write the both formula. So return on equity equals net income first way divided by average equity, right? And multiply by 100. Other way is what? So return on equity equals return on asset divided by 1 minus debt ratio. So we have to again check the question which data is given. Okay. Please, guys, these two ratios I'll explain in the next class also, but there I'll teach you DuPont model. Okay, here I'm just telling you the basic version. DuPont model is the more detailed of these ratios. So here, guys, let's have a look at the question now. They're saying in the current years, a firm had 15 million in sales. Okay, it's a sale value. While total fixed cost were held to 6 million, this is the fixed cost. Firm's total assets averaged 20 million. And debt to equity ratio was calculated how much? $0.6. $0.6. And if the firm's EBIT, this is operating income, we don't need so far because we need net income maybe, but to calculate the net income, we need EBIT in that sense. 3 million. Interest on all debt is 9% and tax rate is 40%. So guys, please remember here, this formula I cannot apply here now. Reason because debt ratio is given, but ROA is not given, return on asset. Maybe I can try later, but I'll prefer this formula because we can calculate net income and we can calculate your average equity also. Okay, so let's have a look how you will calculate average equity first. Please remember again, as I told you. Okay, so let's have a look first. Average equity. So guys, first of all, to get the equity, so I will write the equation assets because equity value straight away is not given, right? So assets equals liability. See the sequence of the question, how I'm solving, guys, plus equity. Assets are given average asset 20 million. If you will recheck here, it's given here, total assets. Okay, 20 million. Okay, guys, that's why. Then what we have here, in the previous question, I assumed asset of 100. Do you remember? But their asset was not given. Here asset is given. So I cannot assume asset is 100. No, assets are given. So then liabilities are not given. So liabilities he told you debt to equity ratio. How much? 0.6 this information. It means liabilities are 0.6% of equity value. Okay, because debt to equity, right? Debt to equity 0.6. It means debt is 0.6% of equity value. If you will take debt to equity, debt divided by equity. Okay, so it means debt is 0.6% of equity value. So that's why I'll write here liabilities is what? 0.6% of equity value plus equity value. Right? This equity is for this. Okay, this is the liability value 0.6 of equity because debt to equity ratio is given. Now I can find out the values of equity. Okay, how? Please, so 20 million equals, if I, because these two values are there, so here we have a mathematically 1 attached here, right? So it will become 1.6 because this 0.6 plus 1, 1.6 E. So E I can find, E equals 20 million divided by 1.6. So if you will solve it, guys, 20 million divided by 1.6. So 20 divided by 1.6. It is going to give you value of equity equals 12.5 million. So equity value, I got it. Okay. Equity value, we got it. Equity value I have now 12.5 million. So it means this I can divide here, average equity. Because this opening equity is not given, so only I will take equity value is how much? 12.5 million. If I remove it, so 12.5 million will become this value, right? 12.5 million. If you will multiply, if you want to put all zeros, just multiply with 1 million. 12.5 multiply 1 million, you will get this value. This is the value of average equity. I hope so you understand the finance values, guys. Now net income I can calculate. How I can calculate the net income? So because in the question, he told you EBT value, EBIT value. So if I'll write it here, EBIT, which is how much? 3 million. I'll write complete value. And from if I'll deduct interest expense. If I deduct what? Interest expense. So then what? So then guys, interest expense you can calculate. How? It's not given, but here he told you interest on all debt is 9%. But I don't know the value of debts, but I can work with the debt value now, guys. Because again, assets equals liabilities plus equity. Assets are given 20 million. Equity, we just found it 12.5 million. It means the difference will be now value of debt. Right or wrong, the difference of these two will be the value of debt now. I can find out, right? The difference of these two will be your liabilities. This is liability. Okay? Liabilities will be how much? The difference of these two assets and equity. If I take 20 minus 12.5, it is going to be 20 minus 12.5. It is going to be 7.5 million. Okay, this is the value of debt. It means I can calculate the interest. 7.5 million means it. This is 7.5 million. If I'll multiply 7.5 with 1 million, I'll get complete value. Multiply by 9% because interest expense is 9%. So I can work with the interest. So look at here. Interest value is percent is 9%, right? So this will give you value of interest. How? So 7.5 million multiply by 0.09. 9%. So it is interest expense is going to be 675,000. So this will give you what? PBT, no, profit before tax. So 3 million minus 675,000. It is going to give you 2325,000. From there, I can deduct tax expense. And tax rate is also given in the question. Tax is 40%. Here is given here, right? 40%. It's 40%. So I'll take 40%. So guys, so 2325,000 times 40%. So tax is going to be 930,000. Deduct. So this is going to be your net income now. So net income is 2325,000 divided, minus 930,000. So it is going to be 1,395,000. Okay, so this is my net income. So I can put it here now in the equation. Net income is 1,395,000 and multiply by 100. So what's the answer now? It is 11.16%. So A is the option, guys. Okay. I know it's technical question, obviously. Every question will not be simple, guys. It will be, some question will be technical also. So then we have here, guys, another question just I'm showing you. For example, they're saying that a corporation has a return on equity, how much? 12%. Return on equity of 12%. And return on asset is 15%. and dividend payout ratio is 30%. So corporation sustainable equity growth rate you have to find. You remember the formula for growth rate? So what's the formula for growth rate, guys? So growth rate will be equal to growth rate. I told you formula return on equity multiplied by 1 minus dividend payout ratio, right? Dividend payout ratio. So return on equity is given, right? 20%. Multiplied by 1 minus dividend payout ratio. Dividend payout ratio is given. It's given here 30%. So 0.3. So 20% multiplied by 1 minus 0.3 is 0.7. So 20 into 0.7, it will be 14%. So this is the growth rate. Okay, guys, we have a lot to discuss, but I'm stopping this video here now. The reason is that next class I'll talk about what is called a DuPont model of return of assets and return on equity, and then I'll explain this summary also. Okay, so this summary I will also explain, and then okay, we'll finish this topic. So I'm stopping here, so because DuPont model I'll explain the next class. Okay, guys. Thank you so much.